Main issue now seems to be whether it is financed out of budget reserve funds or new borrowing. While the economy is likely to recover in Q2, inflation is set to jumpstart with the April print as last year's drop in mobile phone charges falls out of the 12-month comparison. This will lift core inflation measures. In addition, rising food, energy, and metals prices pose a negative terms of trade shock to the world's third-largest economy and boost headline inflation. We suspect the exchange rate will enter a new trading range. Our initial guesstimate is that it is between 119 Japanese yen and 50 sen and 124 Japanese yen and 50 sen. British pound. Spot, $1.3140, $1.3410. Median Bloomberg 1-month forecast $1.3200, $1.3500. 1-month forward $1.3135, $1.3405, 1-month implied vol 7.6%, 7%. GBP was the second weakest major currency against the dollar after the Japanese yen, falling by about 2.65%. It has lost around a nickel this year, of which 4 cents took place in March. While the BOE delivered a 25 BP hike, the 1 cent favored no change, and in the face of the high degree of uncertainty, it softened its forward guidance. It suggested that further tightening might be necessary. In February, it was additional hikes would be likely. The market has fully discounted a hike at the next MPC meeting on May 5. It has about a 20% chance of a 50 BP hike instead of 25 BP. Of course, it is subject to change based on incoming data and official guidance. However, the market judges that the BOE will not keep up with the Federal Reserve, and the US 2-year premium over the UK more than doubled in March to nearly 100 BP, which was around where the pandemic struck. British consumers are experiencing a severe cost of living squeeze amid higher food and energy prices and a National Health Service tax increase, as of April 1. Without extensive fixed-rate mortgages, such as are available in the US, UK households are also more sensitive to higher interest rates. A break of $1.30 could spur a move to $1.2850. That seems more likely than a move above $1.3400. Canadian dollar. Spot, 1.2505 Canadian dollars, 1.2715 Canadian dollars. Median Bloomberg 1-month forecast 1.2520 Canadian dollars, 1.2600 Canadian dollars. 1-month forward 1.2510 Canadian dollars, 1.2710 Canadian dollars, 1-month implied vol 7.2%, 6.7%. The US dollar set the year's high in early March near $1 Canadian dollar and 29 cents before falling about 3.4% to 1.2430 Canadian dollars at the end of the month. The greenback lost ground for 9 consecutive sessions through March 25, matching the longest drop since 2010 and recording the low for the year. The recovery of a small rate premium to the US, the rally in commodity prices, and the stronger risk appetite helped drive the Canadian dollar's gains. Robust economic data, including a monster jobs report, 337K in February and a drop in the unemployment rate to 5.5% from 6.5% and a higher participation rate, and comments by officials encouraged the market, which has almost a 60% chance of a 50 BP hike priced in for the April 13 meeting. The Bank of Canada may also begin allowing its balance sheet to run off. The political arrangement between the Liberal and the New Democrat Party ensures stability for Prime Minister Trudeau's minority government and more fiscal measures. The policy mix trajectory of tighter monetary and looser fiscal policy tends to support the currency. Australian dollar. Spot, $0.7480, $0.7220. Median Bloomberg 1-month forecast $0.7455, $0.7200. 1-month forward $0.7485, $0.7230. 1-month implied vol 10%, 10%. The Reserve Bank of Australia signalled that the first rate hike could be delivered later this year, but the market is not waiting. The April 5 meeting will allow the central bank to adjust its forward guidance. The swaps market sees a hike probable, 85%, in June and definitely in July, and almost 170% of tightening by the end of the year. Unemployment is at 4%, a 13-year low, economic growth is solid, and while wage growth is modest, 2.3% Q4 21 year-over-year, inflation expectations in March, Melbourne Institute, were twice as high. The rise in commodity prices, especially coal, iron ore, and liquid natural gas, generates a positive terms of trade shock for Australia and a windfall for the Australian government. The pre-election, due before May 21, budget provides a 6-month cut in the fuel excise tax, support for first-time home buyers, and infrastructure spending for roads and trains. The Australian dollar rose by about 3.2% in March and was the strongest of the major currencies. The gains were recorded in the second half of the month and lifted the Aussie to its best level since last October. Recall that it peaked in late February 2021 at around $0.8000. The $0.7500 area marks the midpoint of the subsequent decline. Technically, there may be potential into the $0.7550-$0.7600 area, but we suspect there is scope for downside consolidation in April. Mexican peso. Spot, 19 Mexican pesos and 87 centavos, 20 Mexican pesos and 35 centavos. Median Bloomberg 1-month forecast 20 Mexican pesos and 10 centavos, 20 Mexican pesos and 50 centavos. 1-month forward 19 Mexican pesos and 98 centavos, 20 Mexican pesos and 46 centavos, 1-month implied vol 9.95%, 11%. The US USD/MXN high for the year was recorded on March 8, near 21 Mexican pesos and 50 centavos, and proceeded to fall 12 of the following 13 sessions. This included an 11-session slide, the longest in half of a century. By the end of the month, the dollar was probing 7-month lows near 19 Mexican pesos and 80 centavos. Mexico's central bank raised rates by 50 BP for the third consecutive month in March. Banxico meets again on May 12, and the swaps market is divided between a 50 and 75 BP move. It has about 160 BP of tightening discounted over the next 6 months and around 100 BP in the following 6 months. The peso is also a liquid and accessible proxy for other emerging market currencies and especially those in LATAM, which outside of the Russian ruble account for 5 of the top 7 performing emerging markets. The South African rand joins them, and what they have in common are generally high interest rates and commodity exposure. After such a strong run and the coming debate over the controversial electric bill that gives preference to the state-owned utility, the peso may consolidate. This next phase could lift the dollar back into the MXN 20.10-MXN 20.20 area. Chinese yuan. Spot, 6.3400 Chinese yuan, 6.3175 Chinese yuan. Median Bloomberg 1-month forecast 6.3540 Chinese yuan, 6.3800 Chinese yuan. 1-month forward 6.3590 Chinese yuan, 6.3300 Chinese yuan, 1-month implied vol 3.2%, 3.1%. The US dollar recorded a 4-year low against the yuan on March 1 near 6.30 Chinese yuan and spent the month mostly trending higher. The policy divergence reflected in the collapse of the 10-year Chinese premium over the US from over 100 BP at the end of February to almost 30 BP in late March reduces the attractiveness of Chinese bonds for some investor segments. In addition, Beijing's zero-COVID policy has led to lockdowns in several important economic cities, including Shenzhen and Shanghai, and steel and auto-making regions. Chinese officials have signaled a shift from structural reforms to growth, but the market awaits concrete action. A cut in required reserves has been a tool frequently used and could be cut again without warning. However, officials may be reluctant to reduce them much more given the challenges from the property sector and economic slowdown. The benchmark medium-term loan facility rate is 2.85%. It was cut by 10 BP in January after being kept at 2.95% since April 2020. When the pandemic first struck, the one-year medium-term lending facility rate was cut by 30 BP. With less than 1% inflation, there is scope for lower rates. It will be set for the week of April 12. A cut would likely signal a reduction in the one-year loan prime rate, which will be determined on April 19. Q1 22 GDP will be reported the day before. Estimates are around 1% quarter over quarter, but the risks would seem to be on the downside.